What fractional programs are and why they matter. Hello, this is Forrest Owens. I'm an aviation lawyer, a private pilot, an FAA licensed airframe and power plant mechanic. Let's begin with a foundational point. A fractional program is not a jet card, not a club, and not simply a shared cost handshake. In the eyes of the FAA, it is a regulated operating structure. The modern model grew large enough that the FAA eventually wrote a dedicated rule for it. In 2003, fractional ownership rulemaking, the agency explained that executive jet aviation began the first large-scale fractional program in 1986, and that structure grew because it gave individuals and companies increased flexibility in the ownership and operation of aircraft while relying on a common management company. That history matters because it shows why fractional ownership became common in large turbine aircraft. Today, the government framework is 14 CFR Part 91, Subpart K. Section 91.101 defines a fractional ownership program as a system of aircraft ownership and exchange with several required elements: a single program manager, two or more airworthy aircraft, one or more fractional owners per program aircraft, a minimum ownership interest, a dry lease aircraft exchange amongst the owners, and multi-year program agreements covering ownership, management services, and exchange rights. For airplanes, the minimum ownership interest is at least 1/16. The rule is designed to separate a true fractional structure from smaller access products that must be instead operated under Part 121 or Part 135. And the public record confirms how that works in practice. In NetJet's litigation in Ohio, the court noted that a 1/16 share corresponds to 50 hours of annual use. That is a useful benchmark because it translates the rule into client language. So why do sophisticated users of large turbine aircraft like fractional programs? Because the structure solves several expensive problems at once. It gives access to lift without requiring one company or one family office to own, crew, maintain, and schedule an entire aircraft for a mission profile that may not justify whole ownership. It also gives access not only to one tail, but to a managed fleet through dry lease exchange architecture that Subpart K expressly contemplates. There is also a safety and infrastructure point that deserves emphasis. Fractional programs are private operations under Part 91, but they are not ordinary unsupervised Part 91 operations. The program manager must obtain management specifications from the FAA, maintain an operating manual acceptable to the administrator, and establish an internal safety reporting system and incident response procedure. Look at the crew standards alone. Section 91.1053 requires for multi-engine turbine airplanes an airline transport pilot certificate or type rating for the pilot in command, commercial and instrument ratings for the second in command, and baseline experience thresholds, including 1,500 hours for the pilot in command. Section 91.1065 adds initial and recurrent testing. So the selling point is not merely access. The selling point is managed access within a rule set built specifically for high utilization turbine operations. This is why these programs are common. They arise where full ownership is too capital intensive, charter alone is too inconsistent, and the user wants a repeatable fleet standard with institutional support. In a large turbine fractional program, the owner is not simply buying a jet, the owner is buying the governed access to lift. In short, fractional ownership became common because it solved a real market problem. And it survived because the FAA built a dedicated regulatory architecture around it. The structure is convenient, but it's not casual. And here's the takeaway line, something I want you to remember. A fractional program is not a shortcut around aviation regulation. It is a regulated access model designed for serious aircraft users. The positives, negatives, and the misunderstood risks. Now let's turn to the question clients often get wrong. What exactly does the owner receive, and what exactly does the owner remain responsible for in a fractional program? The positive story is easy to tell. The client acquires a real aircraft interest, gains access to fleet, outsources scheduling and maintenance administration, and avoids the inefficiency of carrying the full capital and operating burden of a dedicated large turbine aircraft. In many cases, that's a highly rational decision. But the negative story is where the legal education begins. Fractional ownership is not the same as having unilateral command over one airplane and one crew. It is a bundle of title rights, exchange rights, management's rights, and contractual limitations. That bundle is powerful, but it is not absolute. Subpart K makes this clear. Section 91.1003 requires every owner to have a management contract with a program manager, and that contract must give the owner the right to inspect and audit records relating to operational safety and regulatory compliance, including manuals, logbooks, and maintenance records. The audit right tells you something fundamental, and that is the owner is not supposed to be passive or blind. The reason for this is operational control. Under Section 91.1009 says that an owner is in operational control of a program flight when the owner has the rights and limitations provided by the Subpart K arrangement, has directed the aircraft carry the owner's designated passengers or property, and the aircraft actually carries them. Then Section 91.1011 delivers the hard truth. Each owner in operational control is ultimately responsible for safe operations and compliance. The owner may delegate tasks to the program manager, but the owner and manager remain jointly and individually responsible. This is one of the most misunderstood ideas in private aviation. Clients often assume that because the manager handles the crew, maintenance, dispatch, and manuals, the manager bears the entire regulatory burden. And that is not what the rule says. Section 91.1013 even requires the program manager to brief the owner on operational control responsibilities and obtain a signed acknowledgement explaining enforcement consequences and liability risks. So, the first caution is conceptual. Fractional ownership outsources execution, but it does not eliminate legal responsibility. The second caution is operational. Section 91.1005 says the owner's hours during the term may not exceed the hours associated with the owner's share. The structure is disciplined by contract and regulation. It is not an all-you-can-fly promise. And because the program is built around exchange and substitution, the owner may not always ride on the exact tail number in which the owner holds a share. The third caution is contractual. The public record in the RS Air and Perlman litigation against NetJets is a vivid example. According to the court's recitation, RS Air bought fractional shares, paid fees for management and support services, and then became embroiled in years of litigation after a Citation 10, in which it held a share was damaged and treated as a total loss. The fight expanded into disputes over substitution, contractual obligation, advertising claims, and unpaid amounts. That is a reminder that a fractional relationship is not merely about dispatch. It is a long-term contract stack that becomes very contentious after an irregular event. The best way to explain this to a client is with a simple line to remember. In a fractional program, convenience is heavily outsourced, but accountability is not. In short, the positives are real: lower capital contribution, institutional support, standardized crews, and fleet access. The negatives are also real: reduced individuality, capped usage, layered fee and remedy structures, and a meaningful operational control burden that owners often underestimate. Take this away and remember this: the biggest mistake in fractional ownership is assuming that professional management eliminates owner responsibility. It does not. IRS cautions, excise tax exposure, and litigation lessons. Finally, let's discuss the point that many clients save for the end of the meeting and should raise near the beginning instead, and that is taxes. A fractional interest can produce real tax benefits, but from an IRS perspective, the tax result follows the facts of use, not the marketing brochure. That is especially important when clients start speaking loosely about depreciation. The first caution is that the owner is depreciating only the owner's interest, and only to the extent the aircraft is used in a qualified business use. Aircraft are listed property for federal tax purposes. The 2025 Form 4562 Instructions and Publications 946 make clear that listed property used 50% or less in a qualified business use do not qualify for the Section 179 expense deduction or the special depreciation allowance. This also makes clear that if listed property later falls to 50% or less business use, the taxpayer may have to recapture part of the prior depreciation. That is the IRS warning I would emphasize for fractional interests. A fractional share may be operationally elegant, but it can be tax fragile if the owner does not maintain disciplined records and real business use. The service specifically requires substantiation of aircraft expense, the time and place of travel, the business purpose, and the business relationship of each person using the aircraft. This is a second caution: personal and entertainment use. Treasury Regulation Section 1.274-10 disallows deductions for the use of taxpayer-provided aircraft for entertainment, except in limited circumstances. Treasury Regulation Section 1.61-21 provides the fringe benefit valuation framework commonly associated with standard industry fare level, or what's known as SIFL, or cost per mile for personal use of employer-provided aircraft. And in 2024, the IRS publicly announced that it was beginning dozens of audits of business aircraft involving personal use. The lesson applies just as forcefully to fractional structures. There is also a federal excise tax lesson. In Executive Jet Aviation versus United States, the Federal Circuit rejected a refund claim involving the air transportation excise tax. Years later, in NetJet's large aircraft versus United States, the Southern District of Ohio grants a summary judgment for the government on whether NetJets provided taxable transportation under Section 4261. Those cases matter because they show where sophisticated programs still find controversy, not on whether the airplanes exist, but on what exactly the operator is selling and taxing. So, what is the practical advice for large turbine clients considering a fractional program? Start with mission clarity. If the mission profile supports fractionals, diligent conduct diligence on the manager's regulatory posture, safety system, flight substitution practices, training standards, fee architecture, casualty remedies, and records access. On the tax side, model the ownership entity, business use percentage, passenger use categories, entertainment exposure, fringe benefit reporting, and recapture risk before the first flight is booked. Here is a memorable point. A fractional interest can be a superb aviation solution and a poor tax story at the same time. In short, fractional programs are valuable because they sit between whole aircraft ownership and charter. But the middle ground has rules. The FAA built those rules into Subpart K. The IRS built its rules into the depreciation, substantiation, and entertainment use framework, and the courts have repeatedly shown what happens when owners, managers, or advisors treat those rules as secondary. Here's the main point. With fractional ownership, the main question is not whether the structure is convenient. The right question is whether the structure, the records, and tax posture all tell the same story. Thank you very much for your interest in this topic. This information is provided for informational purposes only and is not legal advice. Please direct questions you may have to admin@aviationlegalcounsel.com. We look forward to helping you with your aviation-related legal needs, and we look forward to helping you navigate these issues with precision.